Good morning, good day, everyone. Tuning into the latest episode of the Crypto and Coffee podcast. My name is Giordano, and I'm joined by Cordell and David Blackstone as per usual. As we're joined at on our biggest milestone yet, episode 20, where we're going to talk about global fragmentation, trade, and supply chain. So grab your cup of coffee, tea, whatever the case is, and sit down and just enjoy us, ramble and yap about this as per usual. So I think, for our listeners out there, people that are not necessarily into the market like we are. Cordell, can you explain what is global trade fragmentation?
You always start with the question that's so broad that I don't even know where to start. And I feel like we always skip a little bit just in terms of a smaller element or an easier way to get into this. But I mean, ultimately, the global supply chain is one of the most important driving forces of the modern economy, right? So when we start thinking about how the global economy has developed over the past 20 to 30 years, it's really just been a push for globalization and to integrate global supply chains, right? So this comes back to a major shift in manufacturing and everything over to China that goes back about 25, 26 years, starting from the late 90s, and is when China really started gaining a lot of that manufacturing prowess and everything shifting over there. In fact, I remember, I don't know if you guys remember this, you guys might be even too young, just to give a little bit of a story as context here. So in 2006, I was working as a sell-side analyst, an analyst for an investment bank covering smaller Canadian companies. And one of those Canadian companies was a furniture company. This furniture company no longer exists. They just couldn't compete anymore because everything was being manufactured here in Quebec. And obviously the cost of labor just couldn't compete as everything was being shifted over to China. So the company eventually tried to shift everything over to China, but it was just too late. Eventually, the company went bankrupt. I don't even know how many people here would even remember this company, but this was like a dominant furniture company for a very long time. And anyway, so I mean, I just remember listening to the CEO and talking about the costs and everything and how all supply chains are shifting. And this has just been a force that's been going on for 30 plus years. It's globalization eventually just shifted all of the supply chains into economies that have cheaper labor. That's pretty much it. And then you take into account the North American Free Trade Agreement, NAFTA, that coming into effect, in the 90s, late 80s, 90s. Then that integrated all of North America into a single supply chain where it comes to a point you can't even identify the source of certain parts anymore. They're just so integrated. So everything is completely integrated now. And what we're seeing is, no need to name names, but I think we all know who's been instigating a lot of it. We're seeing a shift to try and either weaponizing the supply chain, weaponizing money, to try and take back a little bit of that manufacturing prowess or the supply chain prowess that has now come from Asia. So that's just like a broad overview of what's happened, right? We were fragmented, we globalized, and now we're trying to see if we can redo the world order and weaponize the entire supply chains. And that's where I see us right now. It's just supply chains have been weaponized.
Okay. Sounds about right. And would you say based on it being weaponized, most countries would move away from globalization on a whole? Because I know BRICS started because of how the US was basically in terms of the geopolitical power with the Federal Reserve currency.
Well, I mean, definitely the US has dominated everything just because for the strength of the economy. This is where the demand is, right? The demand for goods, the US is a major consumption economy. When you compare it to other major economies, they just don't consume as much as Americans do. And then couple that with the strength, it's the largest GDP. It's just scale. You would think India and China are going to catch up, but they just don't consume, the way that Americans do. If you think about, let's say, the Japanese economy, these are net savers. Japanese save. Canadians save. We don't really, we spend, but nowhere near as much as, let's say, Americans. So Americans have always been the biggest driver because of demand and because of the size of the economy and the GDP. Yeah, no one's going to like that. Everyone, everyone's going to want to have some kind of dominance and try and come back and take, we want our share. Right? I mean, that goes back as far as history goes. I'm sure if you look back at the majority of wars in the ancient world, it's all because of trade routes. It all came down to trying to control trade routes. It hasn't changed. It's just the nature of it has changed. So, yeah, I mean, you're getting more organizations like BRICS and everybody. But I think when it comes down to it is that it's once you have these things put together into a global supply chain like this, it becomes very hard to pick apart. It becomes very hard to pick apart. And I think that net, we have all seen major, I don't like saying we, because it has definitely created what people like to call the K-shaped economy. Some people have benefited from globalization, whereas I would say poor countries and poor classes have not. And that will always be a source of tension. And that source of tension is exactly what populist leaders have seized upon to try and come to power. And whether or not they actually believe in it, who knows? But that's really been one of the major sources of, let's say, the K-shaped economy going back for 20, 30 years is the haves and the have-nots. And that creates a lot of societal strife. I'm using a lot of, I'm trying to be very diplomatic by saying a lot of this.
Okay. And let's just bring it back a little bit. I remember on, previous, episodes, you talked about how China has one of the biggest stake in, global trade and global manufacturing, right? So one of the things I wanted to ask is that, do you think, over the next 5 to 10 years, is it possible for any other country, or any set of countries to replace, China's manufacturing capacity or, stake in global trade? David?
I'm sorry, could you repeat the question?
Yeah, so basically, what I said is that, China basically has one of the biggest stakes or holdings in, global manufacturing or global trade, per se, right? So
Yeah.
do you think, is it possible in the next, 5 to 10 years, is there any country that may have the capacity to actually challenge them?
Within the next 5 years, no. China overtook the U.S. between 2020 and 2026 when looking at the charts for dominant presence within trade. They became the world's primary trading partner between those years. So effectively, you had a flip between 2020 and 2026. Large scale systems don't move quickly. So with China being the dominant trading partner and basically making all of the world's stuff, it's going to take a while if you want to move anything away from them. So within 5 years, no. If the U.S. Wants to regain their manufacturing power, which was where their power came from, then they're going to have to start 5 years ago, and then it's still going to take a couple decades. Because these things are not built overnight. Factories are not built overnight. Supply chains are not built overnight. You have to have time put into these, and it's not measured even in years. It's measured in decades. So you have to get the thing in place, then you have to get everything connected to it, and you have to get that awareness out and things moving. So once you have all of that, in place, then you can expand on it and all that stuff. But it goes in steps. So anytime within the near future, I don't think it's going to happen. But you're going to have to get a lot of things in place for that. And from history, every empire loses for the same reason it started the decline in the first place. And nothing has changed over here. So I don't see that happening anytime soon.
Yeah, I agree. I completely agree. And I the other thing I would say though, because I've been hearing for years, India can come overtake it, whatever. And I haven't seen that happen. It's like, I remember how many people have come into my office back in the day trying to tell me, oh, buy an India mutual fund for my clients. And I just wouldn't do it. The other things I would, I see here is that it's very easy to cheat and to break the rules. And none of us would ever know. Like, just because you buy something and it says made in Vietnam, how do you know it was actually made in Vietnam? Right. So when you start hearing that Bangladesh and Vietnam and even Taiwan have, a lot of companies have moved production or something over there, and they're benefiting from, let's say, a shift to away from China. But I have people, I have friends that own manufacturing companies and that source almost all of their primary materials or whatever from China. And what they said, all the Chinese, what they end up doing to get around it is they just open a factory, an empty shell factory in Vietnam, ship the goods from China into their warehouse in Vietnam, and then ship it to the global supply chain from there and say, hey, made in Vietnam. So, that's what I've heard from people in business saying, it's easy to say, move everything to Vietnam or like that, but you'll never know if those things were actually created in Vietnam or if a Chinese company just opened a warehouse, shipped all the goods there, and then moved everything out of there, and now it's made in Vietnam. So I don't know how we'd ever really verify it. I mean, I'm assuming there are trade bodies and other organizations out there that are qualified and should be doing this. I don't see that dominance being challenged in the near future. I just don't. And, it's like it takes a lot. And as David said, it's like conflicts of empire. There's too much at stake. And I think the Chinese have gotten really amazing at dominating this side of the supply chain. So I don't see it happening in the next five years, at least 5 years.
Okay, noted. And let's just bring it back a little bit for some of our viewers. What is the supply chain? Just in simple terms.
Well, it's just really where you're sourcing primary materials, right? It's where, whether, it's a very tough question to answer just like that, because the supply chain is, if you think about what goes into making, a sweater, right? You need the cotton, you need a zipper, right? You need all of these things. So where are you getting all of these materials from? And then where are they put together to make the final good? So the supply chain is essentially where you are getting all of your primary materials that go into manufacturing or to creating anything, and then getting it to a market. That's the supply chain. So if you think about, let's say, even a semiconductor chip, think about a chip, an NVIDIA chip. They have to get all of their primary materials from somewhere, right? And that's where, it gets very complicated. Is Taiwan Semiconductor the same thing as NVIDIA? No, they're all involved in different parts of the supply chain of where it comes to create that final product. So it can get a little bit complicated. And that's why if anyone who has access to a Bloomberg terminal, they actually have a really cool function that for any company, you can visualize the entire supply chain for that company and see where every single company, like which company supplies the other. It's a really cool feature if you ever have access to Bloomberg, and you can visualize the supply chain it's really fascinating to see. So, but ultimately the supply chain is where you're getting your primary materials from. That's pretty much it.
Okay. And before, I wanted to ask a question about COVID, but one of the things I wanted both of your opinions on, based on what Cordell just said about your semiconductors, would you say, based on how AI is developing at such a fast rate, right? Where, Claude has, Opus, Fable, and, let's say, what do you call it there? ChatGPT also has a lot of, let's say, users. Would you say a semiconductor is a very big asset, a very strategic asset to have?
Which one? Sorry.
A semiconductor. There's a semiconductor.
Oh, as an asset class. All right. So we're talking about from a portfolio, like a portfolio management point of view here, right? Okay.
Yeah.
All right. That's a very tough question to answer, because for portfolio construction, normally the way you want to build a portfolio is, if you're taking a top-down approach, which is the normal professional institutional approach, is you have to define a set of asset classes. Normally we just say stocks, bonds, real estate, alternatives, but then you can keep diving into it. Okay, stocks, I could have Canadian equity, I could have US equity, I could have non-North American equity, and then you can keep subdividing all of your bonds. You can have corporate bonds, government bonds, high yield. So eventually, you're going to have to settle into your preferred classification for asset classes. And then from there, you're going to have to figure out the best way to put the pieces of the jigsaw puzzle together. when you're talking about semiconductors, right? So you're talking about a specific subsegment within other specific subsegments, right? You're talking about equity, let's say US equity, then you're driving into sectors, then you're driving into industry. So you're getting pretty granular at that point. When you're building a portfolio and the way you manage a portfolio, most people that don't really have experience are just throwing darts. They're reading something in the news, they'll buy it. There's no plan that ties it all together. And ultimately, if I ask you this question, what is a portfolio? Like, even just ask this question to yourself, what is a portfolio? What is a portfolio designed to do? If I asked you that question, would you guys be able to answer it? What's your answer? What is a portfolio?
My personal answer is a list of your liabilities and assets.
That's a balance sheet.
Oh, okay. Well, it's probably just, I guess, your list of assets then.
Okay, a list of assets. All right, which is true. A portfolio is a list of your assets. David, what is a portfolio? Someone's like, if someone said, you've mentioned a number of times, you've done very well. You're very good at picking companies. What is a portfolio? How do you put them together?
Yeah, I've only ever seen it used. I've never checked out a definition. You've got art portfolios and portfolio work. I imagine there would probably be a commonality within the definitions of these three different areas. But
there is.
as for specifics, it's not coming to me on that, because I would say roughly the same thing, but probably the set of areas that you're in with a design to with the attempt to try to grow it, as opposed to just the list. But like, for example, portfolio work is an aggregation of your work that you're trying to show off in order to try to get a job. An aggregation of art, a portfolio of art is an aggregation of art pieces that you're trying to use to show off your best quality work. So I imagine that there would be a similarity over here with the portfolio and trying to aggregate and trying to aggregate the assets that you have that are best at growing. But that's just a guess. I've never checked out the definition on that.
Okay. Ultimately, a portfolio, as Gio described, is a collection of assets that are put together to achieve a specific objective. And that objective, yeah, that's what it is. You build a portfolio. Most people say, well, I'm just trying to make money. Okay, that's an objective. You're trying to make money. That's what you're doing, right? We're investing in stuff so that we could make more money. Otherwise, why would we be doing it? No one wants to lose money. So if you're trying to achieve an objective, well, now normally we try and quantify that objective. So ultimately, the goal of a portfolio is to achieve a certain rate of return within a specified risk budget. That's what a portfolio is. It's designed to achieve a specific rate of return within a risk budget so that you can achieve some sort of future objective. Anyone that says, well, I'm just buying this because I think it's going to go up, that's fine, that's great. But that's not normally how we build a portfolio. A pension fund is putting together a specific portfolio because they have to achieve a 5 to 7% of return to fund their future liabilities. That's very technical, what I just said. The average person is building a portfolio to achieve a specific set of money, a return, so that they can retire or buy a house or do something. So if the goal of a portfolio is to achieve a specific rate of return, the question then is, well, where do semiconductors fit into this, or where does anything fit into it? So normally you're going to start with a long-term plan. And that would normally, the most basic long-term plan, which everybody has heard of, is the 60% equity, 40% fixed income. The typical balanced portfolio. Probably going to do anywhere from 4 to 7% a year with about an 8% standard deviation. We usually use standard deviation as our normal risk measure. Great. But what if I start seeing semiconductors and AI? This is where it starts becoming tactical. So whereas your long-term plan might just say 60% equity, 40% fixed income, well, now you still have to make a decision. What is going to be in my 60% equity? And is it going to be static, or do I think I know how to time the market and pick the best places to be in the short run, which is what we call tactical asset allocation. So if you ask me, should semiconductors be in a portfolio? Well, my question is, are we talking about a tactical or a long-term asset allocation, right? Semiconductors are brutally volatile. Okay. You could easily lose 50 to 60% of your money in a normal cycle. Not everyone's going to be comfortable with that. So I have a lot of the semiconductors, but I'm also a big a quant trader, and I do a lot of momentum, and everything is in the chips right now. So it's really comes down to, is it a short-term or a long-term decision? Is it and that's not an easier one to, that's going to be more personal. It's going to be based on your subjective analysis and your subjective views. I personally believe that, yeah, semiconductors absolutely should be in a portfolio. But if you look at, like, they didn't crazy going into the dot-com bubble. So you guys aren't going to remember this, but back in 2000, and I remember telling this story, how the first stock I ever bought, was this biotech company called Affymetrix. I made a killing off it. And then I said, I'm not going to tell you what happened to the money after I put it into the next company. It was a semiconductor company, and it was called Applied Microcircuits. AMCC was the symbol. And then I tried Vitesse Semiconductor. These companies don't exist anymore. I think Vitesse actually does, but I think the stock is like 2 cents. So a lot of, it's a crazy industry. It's a crazy industry. And the companies that you have today might not exist in 20 years from now, because the technology changes so quickly. So yeah, I think it's much more of a tactical play right now. I think there's a lot more room to run in it, but this was a really long answer, Gio, but you asked a very, very loaded question on that. Should people be buying semiconductors? So it's, it really depends, like, where it fits into your overall portfolio plan, or are you buying it just to gamble? And that comes down to a question: what's the difference between a trader and an investor?
I think that's true. And, just to go back a little bit on topic, because there's a question I had. So,
supply chain.
Yeah. So in regards to supply chain, basically it's just where you get your material for whatever you're building, right? So I think COVID back in 2020 really permanently, I would say, changed how global supply chains really operate, right? So one thing I wanted to ask is just, like, how is it operating now based if it operated before 2020? Like, what is the difference from before 2020 to after 2024?
David, you want to go first?
Yeah.
Well, I think that it could probably be summarized as people are figuring out that there are more countries in the world to trade with than just the U.S. So, like, if you've got the rich kid in your class and everyone tries to buddy up to them, well, yeah, they're going to do really well for a while, but eventually people are going to have to figure out, yes, there are other kids in the class that you can talk to. And I think that's what's happening. I think that's what has been happening for a little while now. Now, overall, it's probably been happening for a longer period than 2020, but 2020 kind of accelerated things, especially with the money printing.
Yeah. The way I look at it is, like, COVID, pretty much, we'd never seen that level of demand destruction ever. We essentially saw demand for every good on the planet fall off the cliff, unless you had to get, like, hand sanitizers or whatever is going to keep us all occupied while we were at home. So you need what was in demand? You had webcams, microphones, everything for the virtual world. So demand fell off a cliff, and it's really, like, if you look at the economic indicators through 2020, you're going to see that it destroys the scale of the entire graph, because everything else looks like a flat horizontal line until you see something plummet off a cliff and then rebound 2 months later. So here's what happened. COVID came around, total demand destruction. Okay. Nobody's buying anything, no airlines, nothing. We're all stuck in our house, accumulating our income and our savings for the most part. And it's pent up, and we're consumers. We love to spend money. This is what we've been conditioned to do in our economy. And you have all of this pent up energy. And then at the same time, what's also happened, right? You have all these inventories being built. Since no one's buying, inventories are just piling up. So you're not going to keep producing when you have your inventories piling up. And then you will lay off workers. So it was a huge hit to the economy. And then all of a sudden, what happens is, it's like that pent up demand just got unleashed. So all of us that have been sitting on our houses, we're all rushing to buy goods and services, whether it's flying on a vacation we haven't been able to take for 2 years, buying up anything we can, going to a restaurant, which we haven't been able to do. All of a sudden, you have all of these businesses that are going to wind down all of their inventories. Now they need to produce, but they also don't have the workers because they laid them all off. And then at the same time, the government injected so much liquidity into the system. You're like giving weightlifters as much steroids as they possibly can. And they injected so much steroids into the system. So not only did you have the pent-up demand, you've now given people more money to do this, or just injected so much money into the system. So now everybody's rushing to buy goods. The companies have no workers and their inventories are pretty much coming depleted. What do you get out of that? That's called inflation. And this is exactly what happened in 2022. And the fact that Jerome Powell said it was transient and couldn't see this coming is mind-boggling. Mind-boggling. Like, how do you inject so much liquidity into a system and then see demand rise like that, like crazy, when you have no supply and not expect it to be sticky inflation? Whatever. Easy to say that in hindsight. So the stress that this put on the supply chain was insane. And that's pretty much the world that we're living in today. And I mean, COVID was essentially the main catalyst for everything that we're seeing here today, aside from the trade wars. And then, of course, when you start throwing into social injustice and the K-shaped economy and some people have and some people don't, you know, it just gives it more ammo for politicians to seize upon to try and do stuff or make and affect change. But that's what's happened here. That's what COVID did. Demand destruction, laid off workers, built up inventories, and all of a sudden it's like breaking a dam and that flood water is just rushing out. And that's what happened. That's what caused the inflation of 2022. So, and the supply chains are still recovering to a certain degree, but we've just stressed them with the Iran war. And, you know, that's another huge issue that we have with supply chains right now is the Iran war, not just for energy, but fertilizer, right? Like, if you don't get fertilizer flowing through that straits, you're going to have major hunger crises in a number of countries if you don't get that fertilizer moving soon. So the supply chains are still under a lot of stress. We just keep finding new ways to mess with it.
Mm-hmm. So how would you say, like, let's say a business prepares for, let's say, another pandemic? Because, you know, the hantavirus, it hasn't necessarily been trending, but, you know, it's still a potential to, you know, shut down the world from what I have seen, right? Other than robotics, is there any way for a business to prepare for, let's say, a global shutdown like COVID? David, you want to take that question?
Yeah, now this was happening over time, but COVID accelerated it. You could have people work from home. Now you can't do that for everything, but for a lot of businesses, well, for a lot of areas of business, like for example, finance, you can work from home. If your worker has to do everything on a computer, then whether or not that computer is in the office or in their living room doesn't really matter. If they have to sign into a VPN, regardless of if they're doing it at home or if they're doing it in your office, it doesn't really matter. They're still signing into a VPN. Everything's going through the computer. If you have all of those people work from home instead of from your office, then it doesn't matter if there's a pandemic or not. It doesn't matter who's getting sick. It doesn't matter. Like same for if there's not a pandemic. If someone's kid got sick in daycare and that got them sick, and they come to the office and it gets everyone else sick. Now, if you have everyone come to the office, you've got a lower area of productivity. You've got a lower period of productivity all of a sudden. Now, if everyone works from home, you don't have that. But everyone was talking about this back in 2020, and what everyone was talking, well, maybe not 2020, maybe 2021. But what everyone figured out was that they don't want to sell their office building. They want to bring you in because they want to keep their real estate prices up. And like what we have right now is every asset constantly going up and no one being able to enter the market. Crashes are good. Everything is cyclical, and crashes are good. But we've not had a crash for a while. We had one in 2020, and that was nice. You had a bunch of people enter the market then, but you need them, and if you have things just consistently go and go and go and go, that'll never happen. So you have a lot of young people who are like, basically young people run everything and they can't enter the market right now. But you have to have that, especially if we're going to have another pandemic. It would be nice to have a crash first, so that way we could actually have people enter the economy and care about something because they have something to risk. But up until that, like, yeah, you can just have some people work from home instead. Maybe not for everything, but you can do it for a lot of stuff.
Okay, not Cordell.
So, what can you do to prepare? I mean, see, I don't know, because every time we have a crisis like this, it's different, right? Like, think about like what we've lived through in the past 25, 26 years. All right, so the dot-com bust, right? That was like the first major like disaster that we've seen in this modern technological era, internet and everything. So, I mean, that resulted in the lost decade of U.S. equities. U.S. equity returns were essentially zero. So granted, it's not the same thing as a great financial crisis to a certain degree or COVID. Right. I mean, you're essentially asking, how do you prepare for the unknown? How do you prepare for something that we have no idea what's going to come next? So, could we have seen the dot-com crash? Yeah, very likely. I mean, euphoria into companies where the business models don't exist. These companies had no revenue. Go into the great financial crisis. I mean, I think that was just caused by total greed of bankers and faith in models that made no sense. Oh, yeah, if we lend to people in California, those mortgages are going to have nothing to do with the loans we make in Iowa. Well, that turned out to be really wrong and caused an almost near collapse of the financial system. COVID, I mean, when we're starting to talk about these natural disasters, I mean, like, all through history, we've had events like this. We've had plagues. We've had things like that. We've been way more than overdue for something like this. And COVID, if you think about it, wasn't even that bad. We didn't know what we were dealing with at the time, right? We didn't know. Nobody knew how bad it was or how bad it could get. And governments played it as safe as possible. And we could judge them forever as much as we want. Won't make a difference. We'll probably wind up still arguing about it. They did the best they could with limited information. The fact is, like, we don't know what like a hantavirus or any of these other ones, God forbid something like Ebola turns into something that, has a less of a mortality rate and could actually spread, or like some of these avian flu viruses, like the flu could wipe us all out. If there's ever a virus that could wipe this whole planet, it would be the flu. Because that thing mutates like crazy and easily transmissible. How do you prepare for this? I mean, I think the fact that we saw that how quickly companies were able to put into this disaster kind of continuity thing, the work from home was pretty impressive, right? Like, a lot of companies I saw already had video, teleconferencing capabilities. Zoom obviously was just starting out, was a big beneficiary. So it's companies to prepare, you need to have disaster planning. You need to have a playbook of what's going to be followed when something like this happens, as best as you can prepare for it. And that's the short answer, is that you need to have a playbook for getting people working from home, making sure the minimal interruption to operations. Easier to do when you have a service business. What do you do if you're a bricks and mortar, or if you're a restaurant or something like that?
I've got one for that too. Maybe not for restaurants, but for supply chains, yes. Now, with regards to service companies, well, maybe not service companies, but with regards to tech companies, you can do that with having people work from home. And that does work as a good way of prevention and cost savings, since you can drop the property and just rent one from time to time if you need one, or just not pay for one at all. Yeah, sure, there are tax benefits and all that to paying for stuff, but yeah, sure. With regards to supply chains, though, if you'll have a similar problem in tech as you do with supply chains. Now, if you throw all of your servers into one area and they have a power outage over there, you're going to have some problems. So overall, it's usually better to move those servers around a little bit. You have one in this region, another one in that region, another one in this region over here, because it's very, very unlikely that all of them are going to go down at the same time. Now, if you do that with supply chains, what we ended up with doing with supply chains was last minute delivery and everything comes from China, which doesn't really work that well. If everything comes from the factory down the street, sure, you can find out if something's going wrong. Everyone else knows that something's wrong. You're not really going to have too many people like being angry about it because you just sell locally. Okay. If you're a global business and you're pulling everything from China, no one knows about that. You're pulling everything over from there because you're trying to save money, and you've only gone from there because you're trying to save money and you're trying to be efficient. Now, yeah, sure, you can if you were instead to move that amongst multiple regions, like for example, you have one factory in China, another factory over in Mexico. Then if something happens over in China, you can't get ships across, you can still use trucks if you're in the US. And it's still pretty cheap. You have workers in Mexico that I believe right now are a little bit cheaper than over in China, but I'd have to check the numbers on that. And they're very, very close by. And you also get the benefit of improving the economy of Mexico, which is right next door, which is a trading partner of the U.S. Great, everyone wins. Now, if you do that, and like let's say you throw another factory in another country, let's say Colombia. Great, you now have another place which is really cheap. It's not tied to Mexico, and you've now diversified even more. What's the chance of something happening to China, Mexico, and Colombia all at once? You still have trucks that can go through. You still have ships that can go through. If through this sea, if not that sea, you have diversification. You can have a place that is just that just runs the absolute minimum over near you in the U.S., so you don't have to pay very much, and you can just kick it up when you need to. Should anything happen over in those other ones, these are all failover systems that you have to think through when you're in tech. No one cares about them when you're dealing with physical things. So you can do that for the physical as well. And yeah, sure, maybe you'll have to pay 5% more over here. Maybe you'll have to pay 3% more over there. But should anything big happen, like those aren't really going to impact things very much at those levels. But should anything big happen, then you're secure and you can keep operating.
All right. It's a good idea. I mean, in theory, it could work, I guess, right? I mean, but you're 100% right. I mean, I think the one lesson that's going to be learned is redundancy. I think you said that best. It's redundancy is going to be one of the most important lessons that were learned. I mean, we see that especially with something like, as more and more in the world turns to Amazon Web Services, Google Cloud, and Azure, like what percent of companies now run off that? I mean, it's insane, right? So as we see redundancy with the servers, when AWS has an outage in US East 1, they can easily just shunt everything over to US East 2. So yeah, I mean, the redundancy is definitely, as we get more and more, as the supply chain and everything, all of this, if you think about Google Cloud is, and Amazon Web Services are part of the supply chain now because they host infrastructure for almost every single company. So redundancy is key. Absolutely. I think David said it best there. Redundancy is absolutely key for all of this. But now I want to ask a question for you guys because this is the Crypto and Coffee podcast. Here's my question, guys. How can we use the blockchain to improve the supply chain? Now, that's the one that could make us really think.
Oh, yeah, people have taken a look at that. I don't know if anyone's implemented it, but you can trace the origins of items and get a certificate of record for all of the countries that are going through it. For example, people were pretty mad at what was that tin of cookies that you always have that's never cookies but always sewing supplies? You know that one?
I have no idea what you're talking about.
The blue tin, yeah.
Gio knows.
The what? What?
It's like a blue round tin with like not three different kinds. There's like a whole bunch of biscuits with like three of each biscuit inside there. And normally, there's this old joke where you open it, there's always like a sewing kit inside of it.
Yeah. Every mother used those for sewing supplies instead of like after the cookies were gone. So you always had a surprise. You never knew what you were getting. But
I see what it was like the Danish butter cookies or whatever they were. I think that tin. Yeah, I know. Okay, now I know what you're talking about. Yeah.
Yeah. So the reason I bring those up is because there were a lot of people that were angry finding out that those were made over in India. And they're just like, there's nothing Danish about this. You made them in India, you just ship them over here. And you can find that out instead of having to look on the tin, or well, not look on the tin, but instead of having to look everything up online after finding out like, oh yeah, their headquarters over here. What do they do? Then you can instead check on the blockchain and find that out. You have an API to call, and then you can host it on some web page. And like, no one that's technical is going to go looking through the blockchain, but they will look at a web page. The easier you make things for the information to surface, the more people are willing to look at it. So the tech guys, they pull the information from the blockchain, they show it on the website. Random people go and look at the website. They find out, oh, these aren't actually Danish at all. These are made over in India. They're just tinned over in Denmark. Okay, well, yeah, now you know, and you knew a little bit faster than you did because there's a website hosting this from saved information over on the blockchain.
So if I understand you correctly, David, and I think I do, what you're proposing is we start putting in a little sensor that's tied to the Internet of Things inside every single cookie tin, that we can trace the exact place where every single cookie was made, the temperature that it was stored in, and put this all in a smart contract so that when I buy my cookies, I know 100% where these cookies came from, what temperature they were stored at, and they were shipped with ethical standards. Is that what you want?
Yeah, I want to know very specifically that my cookies were made by Mama K over on 8th Street. Yeah.
This is definitely an excellent application for the blockchain. I'm trying to think of the cost that would go into creating this, kind of putting every single thing on the supply chain as part of the Internet of Things and on a smart contract. Do we have enough hydroelectricity to power the blockchain needed for this?
Yeah,
people are already going crazy over data centers. I mean, how are we going to build, get all the energy needed for this?
I'm actually working with iWealthX on that. There's now they're not doing it for absolutely everything, but they're working on well, they started with finance and they went over to package tracking, but effectively just the package tracking side of things is just we just did it very, very simply. You have QRs on individual items, and those go into a package bundle. And as those packages get moved, like for example in a box or a crate, then you track the crate and all the items that are tied to it because those were scanned in. This is a very, very similar model to GoPuff and how they did logistics. I imagine that's very, very similar to Amazon and how they do logistics. But as it moves country to country, or as DHL updates their site, since you tied their tracking number over to this as well, you can get these updates to find out which countries is this moving through, and where is it likely to end up, where is it now, and when is it likely to end up at the destination.
Well, that I love, and that would, that the applications for that side are incredible, to improve tracking, to improve also to eliminate kind of fraud along this whole part. But yeah, I agree, to be able to track these things and get much better real-time updates on everything, location, conditions of shipment. I mean, imagine you do have, I was joking with the cookies about the temperature, but what if you do have to ship things that are temperature sensitive? And if I'm on the receiving end of these goods, how do I know that the shipping company or that the shipper took every precaution necessary to ensure the quality of the goods? Yeah, the blockchain would be fantastic for these kind of things, because we could have exactly that kind of technology everywhere, recording every single reading. That would be incredible. So yeah, I mean, I think the applications of adding it are just phenomenal. I just don't know, how long would that take to put that into a supply chain? What goes into it? Would we need all of our start throwing in solar energy collectors into the atmosphere? I'm sure Elon Musk is already working on that. And, I'm already getting all the ideas from Star Trek about harnessing a star's power to start powering everything we need for the blockchain.
So I wanted to ask a very, vague closing question to both of you, right? And the whole topic here is, global trade and supply chain, right? So how does AI play a role into all of this in terms of manufacturing, logistics, all that stuff?
All right. AI can absolutely help with supply chain planning. That's without a doubt. Yeah. And, just remember, when we're talking about supply chain management, you have supply side and you have the demand side, right? The whole point is to try and match the two. Now, it's a lot easier to predict the supply side than demand side. And this is what my experience, and I have some friends that work as supply chain managers. So, and they'll all tell you that they're all investing heavily into AI for the supply chain management. It's a lot easier to organize logistics with AI, reading patterns and everything like that, especially based on demand, to how to best update your supply chain to update with demand as demand as demand changes on a frequent basis. Assessing demand is a lot harder. All right. So, trying to plan for demand is a lot harder than it is for supply. So most of the efforts right now are on the supply side, and AI is being used extensively for like supply chain optimization. So essentially, supply chain optimization is a huge business. There's university degrees, departments based on it too. The AI is only improving it because you're just getting better optimization algorithms. Now you're able to handle much more multidimensional data and different kinds of data. Don't forget that you could throw in so many different kinds of like satellite imagery, geolocation data, all of these different things into supply side, and become, really optimize your supply chain that way. So AI is only going to help it. It can help with the AI, with the demand planning, but you're going to get much more uncertainty in the models. Your models won't be nearly as good as they could be on the supply side with optimization.
David, you want to take a crack at it?
Well, I agreeing with Cordell on that one bit. Yeah, it's a lot easier to predict the supply side. I think any parent could tell you that. If you buy a couple of packs of yogurt, everyone will want it. It's going to be gone in a day. If you buy a dozen of it, no one will want it, and it's just going to sit there for all week. Now, I've seen plenty of parents complaining about that, usually with fruit. It's like, oh yeah, everyone wants plums this week. Oh, well, let's buy more. No, now no one wants it. Okay, well they're just going to rot then. Yeah. So you have this whole thing with AI though. I think that it'll be very, very good for surfacing information and helping out with figuring out who you can go to as a good provider or anything along those lines. It's pulled up some providers for various services that I did not know existed. So like it's allowed me to connect with IBKR, for example. I didn't know about IBKR. I only knew about the more popular systems that more people knew about. Like for example, Webull. You've seen Webull everywhere. I knew about that one. But so it can pull out some more interesting providers for various things. I don't think it's going to solve problems on its own. AI is trained on data that of what humans have done already, and it's a predictor of the output. So the more common output is going to be the more likely output for the AI. Now, over time, as you see people try to solve problems, and it's getting trained on the correct solutions, the ones that are accepted by people at the end of those sessions. Yeah, it can get more correct over time, but it's still going based off of humans. Now, on that, everything is cyclical. Like I said, you have human cycles as well in that. You have people coming together and splitting, same for technologies. You have computers that started off as mainframes and they split into laptops and they aggregated over into server groups. You have cyclicality within all of these different things. So with supply chains, I expect it'll go the same way. Will an AI figure that out? I don't think so. Supply chains, they kind of got constrained. They went down to as little as possible in order to save as much money as possible. Will they build up resilience again? Maybe. Will it be soon? I don't know. Will an AI figure that out? I don't think so, because every other business is already trying to cut things down to the bare bones as much as possible. But if you ask the right questions, sure, it could surface the right information.
Sounds about right. I completely agree with you, David. And let's close off the episode here. And I think one of the biggest questions the audience needs to ask themselves, based on what's happening with blockchain, AI, and especially geopolitics, where does global trade and supply chain look? What does it look like in the next 10 to 15 years, or what does it look like in 2035? I think that would be the bigger question right now. So, David, do you want to do the closing today on this episode?
Sure. In 10 to 15 years, I expect that you're going to have the US be taking a little bit of a smaller share with regards to what it has historically, or at least what it has within the last 100 years. And I think that you're going to see a lot of that shift over to the east. I think that you're going to see Singapore do rather well, or at least it has so far. I don't know about the next group of leadership, but the last one has done very, very well. Hong Kong is also a trading hub. ASEAN is all working together. Indonesia, Malaysia, China, they're all trying to de-dollarize and increase trade within that group. So I expect that things, much like they've shifted over to China for the last couple of decades, that it'll probably continue along that path, and that trade is going to shift more eastward as opposed to westward in a continuous direction. You have the G7 facing various issues economically, such as with inflated welfare states and the money printing, because you have like as you see, when you pull in a bunch of people, you kind of have to pay for them too. You have problems that come from larger populations. You have problems that come from smaller populations. They decided to go with a larger population problem. Now. They didn't have the output for it. Now, with regards to that stuff, yeah, you're going to have some issues economically with that. You have those same economic issues arising in the U.S., in Europe, in Japan, in Korea, all these places that are tied to the U.S. As the U.S. falls, I don't think that it's going to take that lightly. I think that they're going to cannibalize their allies. I think they're going to try to pull on those allies in order to prop up the dollar. And I think they're already doing that in places like Japan. Will that endear people to them? No. It's probably going to, much like the trade wars, it's probably going to push them more towards BRICS. So I think that they're going to push everything eastward, essentially.
Okay.
The only thing I would say to that is, if you don't have the demand coming from the Western world for the goods, if you don't have, especially the United States, that could seriously slow down or reduce the impact of having a massive Asian, taking over gains, let's say, within the supply chain. If you don't have the demand coming from the US, it's all academic. You need demand. And where's that demand going to come from? The demand is not coming from Asia.
Mm-hmm. So, all right, let's end off here. Cordell, do you want to do the ending? Closing of episode?
Absolutely. All right. This has been episode 20 of the Crypto and Coffee podcast. This is quite the milestone for us, considering that, when did we start? It was September of last year. When did we do our first one? It was either September or October, I believe, right?
I think it was somewhere in October, August, around that time.
All right. So we're now 9 to 10 months into our maiden voyage of Crypto and Coffee. I think we're all very, very thrilled with the results that we've been getting. We love having our audience. We love some of the feedback we've been getting. We've been getting interest from people that want to come on as guest speakers. That's always nice to have too. So, we're having a great time. We love the fact that people are enjoying what we're doing, and, we're going to keep building on it. And we've got many more episodes planned. And just want to thank everyone for being part of the Crypto and Coffee family.
Mm-hmm. It's a great experience over here. I like to say
that.
We're
enjoying it. Not bad for three guys that didn't know each other at all beforehand. So,
yeah, I guess let's close off there.
All right, everyone. Thank you so much. We'll see you for our next episode, episode 21, coming soon.
Yeah. See you guys soon.
Thank you.